Hello, hello. Good morning, good afternoon, or good evening, depending on when you're tuning into this interview. My name is Robin Waters from Tech.eu, and I'm joined today, remotely, of course, unfortunately, by Raph Crouan and Jamie Moore from Orrick. Raph, Jamie, thank you so much for taking the time.
Thanks for
Pleasure.
having us.
Thanks for having us.
What is Orrick in a nutshell?
Aha. Jimmy, go ahead.
You want me to take that one? Yeah. So we are a global law firm, originally headquartered in the US. Raf and I spend most of our time out of the London office, and essentially the main focus for us is representing both investors and companies at every stage of the investment lifecycle. That's us in a nutshell.
That is in a nutshell. Thank you for keeping it brief, but clear. So originally started in the US and representing investors and scale-ups, which sounds a lot like a certain entity called Silicon Valley Bank. We're recording this on Friday, 10th of March, by the way. I'm assuming that you've been watching the news as well.
We have. Yeah.
Do you have any comment on what's happening with SVB at all?
I think I'm going to hold on commenting on that one until we see how that develops over the next 12 hours realistically, right? It's a fast-paced moving topic, so probably save comment on that one.
Yeah, that's fair enough, but I can't not bring it up on a day like today, which I think is going to be remembered for a very long time in the industry. But moving on to the fun stuff, you guys have put out a report, and I don't want to steal your thunder, so maybe Raf or Jamie can sort of highlight what is this report, how did it come about, what is it about, and why should we be paying attention to it?
Absolutely.
Yeah.
I'll jump in on that. Raf, jump in if you disagree, but essentially about 7 years ago, because I really need to increase my number of hobbies, I thought that it would be really cool to actually aggregate all of the data that we have across the hundreds of transactions that we do. So here at Orrick, we do almost 2 times more venture deals than any of our nearest competitors. And that's a huge data set. And I think we were constantly being approached on negotiations with, this is market. And a lot of our clients, whether they were founders or investors, didn't really know what market was, right? So the main origination of this report was, well, okay, if we're doing more deals than anyone else, we're best placed to actually opine on this stuff. And so what started off as a very, very basic, but now quite huge spreadsheet that I still maintain today, has been replaced with some technology and processes that we've all developed in-house to kind of aggregate our deal data right from the term sheet stage and also the documents that follow. And then we just like to give that back to the community every year as a nice, unique insight into actually what is going on these transactions. And then hopefully coupled with my interactions with the BBCA drafting committee, we not only help interpret what the market is, but we help shape what the market is. So the main hotspot or the main focus is helping investors and companies just close financing rounds as quickly and efficiently as possible. That's the dream.
Fantastic summary, and I'm going to say thank you for not having any other hobbies, because it's also good for us to have that kind of data available to it. Raf, did you have anything to add?
Yeah, just echoing one of the things that for us is extremely important at Orrick is we are a company-first legal firm, and we love to work with entrepreneurs and founders of every stage. And this kind of report is really, as Jamie mentioned, to give back to the community, because it's the unique view and one of the only, view on those terms that, every, founders will be facing, really. And so I think it's an important point in time to look into it, particularly as we all know in this particular podcast, the tech market evolves so quickly that those terms, are critical to be able to get that legacy over the long term. So it's important for us to have a view, as Jamie mentioned, because we've run through more than 500 deals this year on this. It's a pretty good overview of the market and gives us a great indication of where this is going and where we're standing as it's today. So yeah, it's a great report, and we're very happy to be able to share it with the world, I guess.
Great. Well, thanks for that. And you guys have also been quite instrumental in the State of European Tech report that comes out every year, spearheaded by Atomico, of course, but you guys have been part of that as well. So thank you for all the work that you're doing in that regard.
Thank you. And on a side note there, Robin, just to come back to what we were saying before, the the State of Europe and Tech is also done in collaboration with SVB, as you know. So, and not that we want to do any comments, but I just want to highlight the fact that we're close to the firm. They're close collaborators of ours, and so we're we're watching the space, and we'll see what happens later on. But yeah, it's a tough day for a lot of people. Yes.
Yeah, absolutely. And I think it's going to have wide and deep repercussions, but we'll have to wait and see what those are. Okay, let's move to the report, the actual report. Maybe before we dive into the findings, Jamie, you mentioned, and the report also mentioned, that this year, or for this edition, you've been using new technologies and processes to actually get it done. What does that mean?
Yeah, so I'm really proud of the fact that Orrick actually has its own innovation lab here. We have folks in the US who are happy to listen to me because, fundamentally, before I was a lawyer, I was a massive techie myself and used to code and get involved in that software side of things. So we actually have a in-house team based in the States who kind of helped us create different softwares to actually analyze term sheets as well as not just Excel, right? This is data collation, but it's more sophisticated. So we actually have processes, questionnaires, and some pretty cool tech that helps us streamline that process. And so this year, unlike previous years, this is the third iteration of Dealflow. We've been able to use that technology to kind of delve deeper into the term sheets in a more efficient way. So it's not like there's an army of 50 people typing this into a document. It's actually technology driven, technology led, and it's helping us review documents and review term sheets to then help with the analysis and collation of this data, which is really nice.
Which, when you think about it, for the very first European technology law firm, makes sense to use technology. So that's exactly why we did it.
It does make sense, but it's really good to know and helpful before we dive into the actual findings, which we're going to do now. So what's the deal with Dealflow? I'm going to be honest, because we're recording this quite soon after the report's release, so I haven't been able to dive into the report in great detail, but you very helpfully provide sort of the 5 main things or the main takeaways that you've learned about European tech deal terms last year. So what I'm going to do is I'm going to go one by one, read the headline, and then you could sort of dive in more detail about each and every one of those and explain a little bit more. So we're going to start with the first one. Market instability has led to a shift towards more investor-friendly terms, which I think is a nice way of saying less founder-friendly terms, including things like only 47% of equity financing, including a top-up to the option pool, that sort of thing. But I'm sure you can explain in a lot more detail how and why have the terms gotten less founder-friendly.
Yeah, absolutely. I think the biggest takeaway, slightly contrary to the kind of headline here, but is like this report is definitely not doom and gloom. It's still a great ecosystem. There is still fantastic money for fantastic companies, but naturally we're seeing a rebalancing, right, of power. So 2021 was the year where we had lots of founder protections that started early and lasted later into the financing cycle through founder vetoes and other bits and pieces. But quite naturally, anyone who's been reading the news over the last year has seen the various economic inputs and changes, which have quite naturally led to just a slightly increased degree of sensitivity on the investment side. And I'd say that's not a complete rebalance. It's just a slightly delicate but perhaps needed shift towards more sustainable and thoughtful investing. So as a result, a few things that we've seen. The first point is that I think as an industry we've agreed that the need for founders to be personally liable for warranties has and should hopefully fall away. The idea is that portfolio companies aren't being sued by their investors, and the warranty process is more about information flow as opposed to risk appetite. And so as a market, we have started to shift away from founder warranties more towards company warranties. That's certainly confirmed in the latest standard form documents. However, last year, I suppose, partly due to market sensitivities, we've seen a slight rejection of that position, in the sense that founders are still being requested to stand behind some of these warranties. I think the nature and scope of those warranties will change, and so that position will probably change this year and go back to the norm of the company focused only warranties. We've seen lots of focus and attention to the cap table, so quite naturally, last year was the year when people were very careful with valuations, and when they did raise, they had to raise smart. And so as a result, only 47% of the deals that we saw included some form of top up to the option pool. Normally we'd quite see that a lot more regularly. I think the knock-on effect of companies being slightly more cautious when it comes to hiring, but also investors and existing shareholders being more reluctant to suffer dilution. That's a natural byproduct to see a reduced amount of top-ups. And then the third bullet there in our summary is already mentioned in the previous bit. In 2021, we were able to, even at the seed stage, create founder structures that would give founders a greater degree of control later on into the business. Quite naturally, I think we're seeing in the news, the question of whether or not it's right that a founder remains the CEO in a company long term. So, naturally, there's a shift on whether or not it makes sense for founder veto matters to remain forever. Sometimes that's good. Sometimes it's actually useful to have some founder veto matters. So I'd say they're not gone. I'm doing a deal right now that includes a whole raft of them, but they just need to be more justified and thought out.
Yeah, makes sense. I'm going to stay on the topic a little bit more because I'm wondering, in your view, when will we see a shift back to normal? And when I say normal, I don't mean 2021. I'm rather talking a bit more like the way it was like in 2018 to 2020, I would say.
Yeah, the big question of what is normal. I think the first half of this year has been quite interesting to see. I'd say this first quarter is probably a slight reduction in the number of deals that are being done. Transaction value drops, as we've mentioned in the report. I'd say probably the second half of this year is where we start to see the pickup. If we think that, I think we mentioned it in our report as well, that the venture debt market had a 405% increase just in December alone before this year started. So runway is already pitched, and investment activity is therefore going to be a bit slower right now. But I'd say meaningful movements towards the second half of this year.
Yeah. Well, let's unpack this deal size thing a little bit more, because as Raph mentioned, you've analyzed over 500 deals. In total, I think about more than $12 billion worth. So that gives you quite a lot of information to work with. And the general gist of it is that the average deal size has dropped, of course, because of all the late stage funding is also vanishing. I would use the word vanishing, while the deal volume actually remains relatively high. So can you elaborate on that a little bit?
Yeah, exactly. And so that 12 billion from Orrick roughly equates to over 25% of the capital raised in each of our core European markets, whether it's France, Germany, Italy, the UK, etc. So a really good foothold in each of those markets. I think, as Raph mentioned at the beginning, we traditionally have a larger exposure on our company side mandates. And we've obviously seen a very slight drop on the investor side mandates this year just gone. That's partly due to companies looking at more innovative manners of raising finance in these times. So they're not typically needing to go to external investors. Therefore, the investor mandates come down. Therefore, the increase in ASAs and safes go up, right? And so naturally, these kind of bridging instruments are of smaller valuation, but there's a large number more of them, right? And so you couple that with companies looking at innovative kind of rolling closing mechanics and things like this, the number of deals just goes up, and the average changes as a result, I'd say.
Yeah. Raph, did you have anything to add?
I think no. I mean, there's no need for me to comment more than this. On the technical side, Jamie will have the better take on this. But I would say just generally the market is seeing, as we said, not a crash, but a correction in a way of things are being done, and it's natural to see the terms being, reflecting that in a way. So the size, of the deals are, smaller. We see the number of deals reducing. We've seen the debt equity in the same kind of fashion growing next to the equity side. So all of that seems to be quite natural, and that's why we wanted to analyze it at this particular time, of the development of the product of the market. I'm eager as much as you are to see what's happening in the next 6 to 8 months. I don't have a crystal ball with me, unfortunately. So
even beyond that, I would say, because it's going to take
Yes.
a while to recover. Because the correction, most of us saw it coming, but it happened very abruptly and very significantly. I think to much faster and much more significant than we all could have anticipated. So, okay, I want to get to the third point a little bit, because you mentioned venture debt a few times. We track all the deals in Europe, of course, every week, so we know we see that as well. Debt transactions are rising, both in volume, in size, the value, also geographically spread. It's everywhere now. So that brings a new level of competition between lenders. What I'm wondering about is that going to be a long-term change, or is it just because the market dictates the fact that equity finance is harder to get, so you look for alternatives?
Yeah, a really interesting question. I think when we came out of the era of the future funds and have seen how that has interacted with the debt market, it's quite interesting to see that whilst there's an uptick in the number of venture debt deals, the terms under those providers are still, increasingly, in some cases, quite expensive for companies. Future fund transactions kind of set a very high benchmark in terms of discount to future round prices and things like this. And we've analysed in our report, how many of those companies have then subsequently been able to go on and raise at a attractive rate. I'd say what's interesting and shouldn't be forgotten is the increase on the venture debt stuff is definitely noted through a large number of lenders and increasing protections on their side that mirror more equity terms than one might normally traditionally expect. But there's still a huge utility and need for the ASA, as we call it in the UK, or the SAFE in the US. And so we've even adapted here at Orrick our own UK equivalent of the US SAFE, and that translates really nicely. So when we speak about venture debt financings within the report, there is definitely a big crossover within other forms of convertible instruments, whether it's an ASA or a SAFE as well. I think they're definitely here to stay. Realistically, for companies, certainly at the seed stage, and the growth of the seed market is still huge. We're seeing lots of earlier stage investments. They can be a really efficient way of raising that first 1 to 2 million instead of spending a lot of time and legal fees on long form documents.
Yeah, absolutely. I'm part of an angel investments collective here in Belgium, and we just introduced a convertible note template based on the US SAFE as well, which Belgium didn't even have before. So, and that's also driven by demand. You could tell that startups are really eager on an early stage to really have that kind of option.
Yeah, absolutely.
All right, so then we move to the fourth main takeaway, which is about the sector, and specifically about fintech, which, according to the report, took the brunt of rising inflation and reduced investment budget, but also continues to be the top sector for investment activity in the analysis.
Yeah, so I mean, we had a huge crop of late stage fintech deals, obviously, in 2021. This year, perhaps to a lesser extent. We still see some really high growth on SaaS and platform-based market shares. Fintech still remains predominant, of course, but quite interesting to see later in our report. Actually, uptick on some blockchain companies as well, and of course, the broadly defined sort of health-focused companies, especially in the kind of macro, larger economic environment that we find ourselves in, whether it's mental health or otherwise, has definitely seen a huge increase. So yeah.
And I would add two things of this. First, the Web3 element to it, which is not going anywhere, and it's only increasing right now. linked to fintech to some extent through the transaction that we get, but also, to the metaverse element. So all of those transactions we see increasingly, popular, and also taking on some regulation sort of framework / issues. So we have also a lot to do with that. And the second element I had to this is, of course, the fact that healthcare on the post-COVID time, is increasingly important for people that are a lot more self-aware of things that they might not have considered before. So not only mental health, but also health in general. And the third thing is, we've seen an uptake on many different sort of new technologies that are touching biotech in general. And so it's these days, the capital invested in biotech is increasingly high and higher than we've ever seen in the past. It might not be as well reflected in this report because it's a burgeoning area and it's actually small compared to the rest of the other segments, but it is something that we also experience in the market for sure.
Yeah, and I'm sure we'll see more data on that in the next edition of the report.
Correct.
For that matter.
Absolutely.
So we're talking about sectors. One other one that was highlighted in your analysis was software as a service, or as you describe it, SaaS and platforms, which according to you saw the largest growth in deal volume, 1.5 increase, while the investments into the category retail and marketplaces fell by an astonishing, I think, 65% last year after the major boom in the second year of Corona.
Yeah, absolutely. It's quite interesting how we're characterizing some of these companies as the sectors. They kind of pivot within change as well. But
yeah, there's probably a crossover there as well, right?
There is.
Yeah, exactly.
Platform and marketplaces. How do you define the difference, right? There's a lot there.
Yeah.
Trust me, I've been managing a database for the last 10 years, so I feel the pain. Not always easy. But great. So those were the 5 main findings. Of course, there's a lot more in the report. We're going to link to it in the show notes, of course. And you also speak a little bit about broader market trends. Can you sort of summarize the summary there?
Absolutely.
I think we spoke a little bit about this earlier, right? The geopolitical and macroeconomic context, of 2021 and 22. We could see that the funding slowing down. We saw, some of the debt market grew. We mentioned that. Clearly, valuation was clearly impacted, so we saw a lot less unicorn creation, which is something that we all feel is actually quite reasonable considering how crazy those valuation went and grew. So we're getting to, for me and Jamie, I'm sure you agree on this, we're getting to a correction rather than a crisis or a bust, right? So it's about slowing down a bit, getting back to a reasonable amount of due diligence being done on every single company, 3, 4, 5, 6 weeks. Going to an amount of capital that raised that is linked to proper unit economics and some reasonable sort of scheduled time frame on deployment of the capital, but also on how do you make money, how do you create your actual revenue-based company, and so some of the classic things that we've seen, as you mentioned, Robin, before back in 2018, 2019, more less bullish times, more sort of reasonable growth time. We also see institutional investors looking a lot into the ESG metrics stuff. That's something that everybody has seen over the last few years, but now they actually mandate that quite sometimes, and so until you actually have proven that you have a framework in place, that you actually measure those, frameworks, and those sort of KPIs, then you might not receive any investment whatsoever. If I'm not wrong, and Robin, correct me, I think EIF to some extent even mandate that to their fund as an LP, saying, we're not investing in you unless you actually have put in place some sort of mechanism to track not only yours, but also your portfolio funds as well. So it's trickling down. It's a good thing to see. It's a requirement that has been long overdue, and hopefully this is going to be standardized at one point. We all know there's so many different options out there. That might be one of the issue today.
Yeah, I absolutely agree with that. And you're right. The EIF actually does mandate that. They're not the only LP that does that. In Europe, quite a lot of them. And what's interesting to me, at least, is that it's not just driven by the LPs and within the VC community. It's also the new generation of entrepreneurs actually demanding from their investors that they have sort of an ESG policy or strategy in place, which I think can only be...
It's become an entire segment as well, and one that we've seen growing in our clients as well. We see ESG companies specifically targeting not only the framework and the measuring, but also any kind of impact around the planet or the business itself. So we're seeing a lot of companies flowing in that way, for sure.
Fantastic. Jamie, anything else from the report that you wanted to mention before we wrap it up?
Yeah, those are the highlights. I think look, the main aim of the game, as I always say, is it's a market of opportunity, right? It's a time for companies to raise smart. I think definitely doubling down on the sense that it's not doom and gloom. There is always great opportunities for great companies, and maybe this kind of reflection of how we raise and raise more efficiently is good. It's a good time to do these things. And yeah, I think main takeaway is that we continue to really love helping our clients innovate and close these transactions, and we're ultimately very grateful to the ecosystem for giving us this data to then analyze and report back on. It's a really privileged position to be in. So
fantastic. Well, final question is, when's the next iteration or the next edition of this report coming? I know you just released it, so it's a bit of a shitty question to ask, but I'm still going to do it.
No, it's a fair one. As I mentioned
question.
earlier, yeah, I mean, the market evolves so quickly that so we'd love to be able to get it out every quarter or so. But to be realistic, we might consider a refresh mid-year. We'll see if we manage to do that. Up to now, it's a yearly exercise, and of course, you don't want to make an analysis on 10 deals, right? You have to have a sort of a proper sizable sort of sample to be able to analyze and to get some proper conclusion over this. So, which is why we do it over a year exercise. Having said that, as you mentioned earlier, we also participate every year to the State of European Tech actively with our friends at Atomico, and so we should have also a large pool of data out of this that might not be specifically term oriented, but gives more of that sort of market view in general. So we'll see. And that's probably in between.
Cool. Well, as a data nerd and specifically data on European tech, I can only say thank you for doing all the work and releasing the report publicly for free to anyone. As I said, I'll link it in the show notes. So we're going to wrap it up. People can take a look for themselves. But thanks again for sharing your insights here, and best of luck with all the SVB things going on.
Thank you, Robin.
Thanks, Robin.